The year is 1944. World War II rages on, leaving cities in ruins and economies shattered. Amidst this turmoil, world leaders convene in Bretton Woods, New Hampshire, to build a new economic order. This conference would lay the foundations for a more stable and prosperous world. The Bretton Woods delegates faced the task of rebuilding economies and ensuring global financial stability. They established a system of fixed exchange rates, pegging currencies to the US dollar, which was convertible to gold. The agreement also created the IMF and the World Bank to provide financial support and promote development. The Bretton Woods Agreement ushered in an era of economic growth and stability. It fostered international cooperation, with countries managing currencies and promoting trade together. Despite its eventual end, the legacy of Bretton Woods and its institutions, the IMF and World Bank, endures. World War II left cities in ruins and economies crippled. Resources were redirected to military production, leading to shortages and inflation. International trade halted, and countries were burdened with debt. The global economy faced a bleak future, with the specter of another depression looming. Governments struggled to rebuild while managing crippling debts. The need for a new economic system became increasingly apparent. The Marshall Plan provided crucial aid to war-torn Europe, helping to stabilize economies and restore growth. International trade began to recover, laying the foundation for a new global economy. Post-war, nations turned inward, erecting trade barriers to protect their economies. This rise in economic nationalism fragmented the global economy and stifled growth. During the interwar period, countries implemented key protectionist policies like the Smoot-Hawley Tariff Act of 1930 in the United States. This act raised U.S. tariffs on over 20,000 imported goods, leading to a significant decline in international trade. Countries around the world responded with their own tariffs and trade barriers, exacerbating the global economic downturn. These protectionist measures led to a decline in international trade and economic cooperation. While some domestic industries thrived, the overall global economy suffered. The impact was severe, with international trade volumes plummeting and economic recovery stalling. World leaders recognized the need for cooperation and open markets to avoid disaster. The collapse of the gold standard added to economic turmoil. The gold standard was a monetary system where a country's currency, or paper money, had a value directly linked to gold. Countries agreed to convert paper money into a fixed amount of gold, ensuring stability and trust in the currency. The Great Depression, starting with the 1929 stock market crash, severely strained the gold standard. In 1931, the United Kingdom abandoned the gold standard, followed by the United States in 1933 under President Franklin D. Roosevelt. Currencies floated freely, leading to volatile exchange rates and risky international trade. The gold standard had initially facilitated international trade by providing a stable exchange rate, but its rigidity also contributed to economic instability during crises. The collapse of the gold standard marked a significant shift in global economic policies. Visionary leaders laid the groundwork for a new economic order during the war. In August 1941, the Atlantic Charter was signed, calling for economic cooperation and trade liberalization. Key figures like John Maynard Keynes and Harry Dexter White played pivotal roles in shaping the discussions. In July 1944, representatives from 44 nations gathered in Bretton Woods, New Hampshire. They convened at the Mount Washington Hotel to create a new international monetary system. The conference aimed to establish financial stability and prevent future economic crises. The conference featured brilliant economic minds, including John Maynard Keynes and Harry Dexter White. Keynes, a British economist, was a key figure in the development of modern macroeconomics. He advocated for government intervention to mitigate the adverse effects of economic recessions. Harry Dexter White, an American economist, played a crucial role in the U.S. Treasury. He favored free trade and a dollar-based system to stabilize the global economy. The Bretton Woods Conference, held in July 1944, brought together 730 delegates from 44 allied nations. It was a pivotal moment in shaping the post-war global financial order. Key figures like U.S. Treasury Secretary Henry Morgenthau Jr., also played significant roles in the negotiations. Their differing visions and collaborative efforts culminated in the Bretton Woods Agreement, which established the International Monetary Fund and the World Bank. Keynes and White had different visions for the global economy. Keynes proposed an international clearing union with a new reserve asset, Bancor. White favored a system anchored to the US dollar, reflecting America's economic dominance. The debate came to a head at the Bretton Woods Conference in July 1944. Keynes, representing the United Kingdom, argued for a more balanced global system. White, representing the United States, pushed for a dollar-centric framework. Ultimately, White's vision prevailed, leading to the establishment of the International Monetary Fund and the World Bank. This decision cemented the US dollar's role in the post-war global economy. This agreement laid the foundation for post-war economic growth and stability, influencing global economic policies for decades to come. At the heart of the Bretton Woods system lay a novel monetary arrangement known as the gold dollar standard. This system aimed to provide a stable foundation for international trade and finance by pegging the value of the US dollar to gold, while other currencies were pegged to the dollar at fixed rates. Under this system, the United States guaranteed the convertibility of the dollar into gold at a fixed rate of $35 per ounce. This convertibility provided a sense of security and stability to the system, as it instilled confidence that the dollar, the linchpin of the system, had a tangible backing. The choice of the US dollar as the anchor currency was no accident. The United States had emerged from World War II as the world's dominant economic power, possessing the largest gold reserves and a stable political system. This preeminence made the dollar the most suitable candidate for underpinning the new international monetary order. The gold dollar standard, by linking other currencies to the dollar and ultimately to gold, aimed to prevent the volatile currency fluctuations that had plagued the interwar period. Stable exchange rates, it was believed, would foster international trade and investment, as businesses could engage in cross-border transactions with greater certainty and reduced exchange rate risk. While the Bretton Woods Agreement promoted the free flow of goods and services across borders, it recognized the need to regulate international capital flows. The agreement allowed countries to maintain capital controls, restrictions on the movement of money across their borders, to prevent destabilizing capital flight and speculative attacks on their currencies. Capital controls were seen as a necessary tool for governments to manage their economies and maintain financial stability, especially in the early years after the war, when many countries were still recovering from the devastation. These controls could take various forms, such as limits on foreign investment, restrictions on currency trading, or taxes on capital outflows. The use of capital controls was controversial, with some economists arguing that they hindered investment and economic growth. However, proponents of capital controls argued that they were essential for preventing financial crises and allowing countries to pursue independent economic policies without being vulnerable to the whims of international investors. The Bretton Woods system, by allowing for capital controls, reflected a compromise between the desire for international cooperation and the need for national autonomy in managing economic affairs. It acknowledged that while free trade and investment were desirable goals, they needed to be balanced against the need for financial stability and the right of countries to pursue their own economic policies. Recognizing that even with fixed exchange rates, countries might still experience balance of payments difficulties, the Bretton Woods Agreement established the International Monetary Fund, or IMF. The IMF, headquartered in Washington, D.C., was tasked with providing short-term loans to member countries facing a shortage of foreign exchange reserves. These loans, funded by contributions from member countries, were intended to help countries bridge temporary gaps in their balance of payments, allowing them to maintain their fixed exchange rates without resorting to disruptive measures such as devaluations or trade restrictions. The IMF acted as a lender of last resort, providing a safety net for countries facing financial difficulties. In addition to providing loans, the IMF also played a role in promoting international monetary cooperation and exchange rate stability. It monitored the global economy, provided technical assistance to member countries on economic and financial matters, and served as a forum for international policy coordination. The IMF's role, however, extended beyond simply providing financial assistance. It also imposed conditions on its loans, requiring recipient countries to implement economic reforms aimed at addressing the underlying causes of their balance of payments problems. These conditions, often controversial, aim to promote sound economic policies and prevent countries from becoming overly reliant on IMF assistance. While the IMF focused on short-term financial assistance and exchange rate stability, the Bretton Woods Agreement also created the International Bank for Reconstruction and Development, later known as the World Bank, to address the long-term development needs of war-torn and developing countries. The World Bank, initially headquartered in Washington, D.C., alongside the IMF, was tasked with providing long-term loans and grants to member countries for reconstruction and development projects. These projects ranged from rebuilding infrastructure destroyed during the war to investing in education, healthcare, and other sectors crucial for economic development. The World Bank's mission was rooted in the belief that economic development was essential for global stability and prosperity. By providing financial assistance and technical expertise, the bank aimed to help developing countries break out of poverty, achieve sustainable economic growth, and improve the living standards of their citizens. The creation of the World Bank reflected a growing recognition that the post-war economic order needed to address the needs of developing countries, not just the interests of the wealthy nations. It represented a commitment, at least in principle, to fostering a more equitable and just global economy where all countries had the opportunity to prosper. The World Bank's mission has continued to evolve in response to the changing global landscape. As the world grappled with new challenges, such as climate change, pandemics, and financial crises, the bank adapted its approach to development, recognizing the interconnectedness of these global issues. Climate change, with its potential to exacerbate poverty, displace populations, and disrupt economies, emerged as a central focus for the World Bank. The bank increased its investments in renewable energy, climate-smart agriculture, and disaster risk management, recognizing that addressing climate change was integral to achieving sustainable development. The COVID-19 pandemic underscored the importance of global cooperation and the need for a coordinated response to health emergencies. The World Bank mobilized quickly, providing emergency financing and technical assistance to developing countries to strengthen their health systems, mitigate the pandemic's economic impact, and support their recovery efforts. The World Bank, while adapting to new challenges, has also faced criticism over its lending practices, its impact on the environment, and its governance structure. These criticisms have prompted calls for greater transparency, accountability, and a more inclusive approach to development, ensuring that the voices of developing countries are heard in shaping the global development agenda. The IMF and World Bank, products of a bygone era, have faced calls for reform and adaptation throughout their history. Critics have argued that these institutions, conceived in a different time, no longer adequately reflect the realities of the 21st century global economy, with its shifting power dynamics and the rise of new economic powers. Despite these criticisms, the IMF and World Bank remain central to the global financial system, embodying the enduring legacy of Bretton Woods, the belief in international cooperation, the pursuit of economic stability, and the importance of a rules-based international order. The challenges facing the world today, from climate change to pandemics to inequality, require global solutions. The IMF and World Bank, with their global reach and their mandate for cooperation, have a crucial role to play in addressing these challenges and building a more stable, prosperous, and equitable world. As the world navigates the complexities of the 21st century, the legacy of Bretton Woods, embodied in the IMF and World Bank, serves as a reminder of the enduring power of collective action and the need for a shared commitment to shaping a better future for all. The Bretton Woods system ushered in an era of remarkable economic growth and stability. Post-WWII saw a resurgence of international trade and a rise in living standards. This period, known as the Golden Age of capitalism, saw economies flourish. The fixed exchange rate system provided a stable environment for international trade. Businesses could confidently invest in new markets and expand operations. This predictability fostered a surge in cross-border trade. The IMF and World Bank played crucial roles in supporting growth and stability. As the 1960s progressed, the global economy began to experience factors that undermined Bretton Woods. Its success paradoxically contributed to its demise. The volume of dollars outside the U.S. grew, pressuring gold reserves. Rising U.S. inflation fueled doubts about the gold dollar standard. The fixed exchange rate system became rigid and hard to maintain. Countries had to subordinate domestic policies to the system. This loss of autonomy was untenable for countries facing downturns. Global capital markets and easing capital controls posed challenges. Capital mobility made managing exchange rates difficult. The system struggled with rapid money flows. Political pressures also mounted on Bretton Woods. The U.S., burdened by the Vietnam War, was reluctant to maintain the gold dollar standard. Other countries questioned the fairness of the Bretton Woods order. The stage was set for a realignment of the global monetary system. The demise of the Bretton Woods system unfolded with dramatic swiftness. In August 1971, President Nixon ended the dollar's convertibility into gold, breaking from the gold dollar standard. This unilateral action sent shockwaves through the international monetary system. The initial response was disbelief and confusion. Governments scrambled to assess the implications and formulate a response. Efforts to salvage a modified Bretton Woods system proved futile. The world faced a new era of floating exchange rates. The collapse ushered in greater exchange rate flexibility and volatility. Businesses now had to contend with fluctuating currency values. The end of Bretton Woods marked a profound shift in the global monetary landscape. The Bretton Woods system, once a beacon of stability, succumbed to a changing world. Its collapse marked the end of fixed exchange rates and the gold dollar standard. The world entered an era of floating exchange rates and globalized capital markets. The IMF and World Bank, created by Bretton Woods, remain central to the global financial system. They stand as a testament to international cooperation, adapting to a complex world. Today's challenges, climate change, pandemics, inequality, demand global solutions. The spirit of cooperation from Bretton Woods remains essential for addressing these issues.